Hello there, financial enthusiasts. We're thrilled to have you here. Before we dig in, remember to hit that like button and subscribe to our channel for more insightful content. Today, we're diving into an intriguing topic that's often shrouded in mystery: the fascinating interplay between interest rates and the stock market. Now, don't let those big words intimidate you. We're here to simplify and shed light on how these two seemingly disparate elements are, in fact, closely intertwined. We'll explore how shifts in interest rates can send ripples through the stock market, influencing the performance of your favorite stocks. But let's not get ahead of ourselves. It's important to remember that this content is purely educational. We're not offering financial advice, but rather providing an enlightening guide to help you navigate the financial landscape better. So, grab a note as we're about to demystify the complex relationship between interest rates and the stock market. To start with, let's understand what we mean by interest rates. Think of interest rates as the price tag for borrowing money. Just as you pay for a car or a house, you also pay for the privilege of using someone else's money. If you borrow money, you pay interest. If you lend money, you earn interest. Let's say you borrow $100 from a friend and agree to pay back $110 at the end of the year. The extra $10 is the cost of borrowing, or the interest. In this case, the interest rate is 10%. But interest rates aren't just a concern for borrowers and lenders. They're a fundamental part of our economy, guiding decisions from the largest banks to the smallest households. That's because central banks, like the Federal Reserve in the United States, use interest rates as a tool to control inflation and stimulate economic growth. Here's how it works. When the economy is slow, central banks lower interest rates to encourage more borrowing and spending. This is because when it's cheaper to borrow, people are more likely to take out loans to buy houses, start businesses, or make other large purchases. All of this spending can then stimulate economic growth. On the other hand, when the economy is overheating and inflation is high, central banks raise interest rates. This makes borrowing more expensive, which can slow down spending and cool off the economy. So, in a nutshell, interest rates are like a thermostat for the economy. They're adjusted up and down to keep economic growth and inflation at just the right temperature. But what does all this have to do with the stock market, you might ask? Well, the relationship between interest rates and the stock market is complex, but fundamentally, interest rates affect the cost of borrowing for companies, which can impact their profitability. They also influence investors' decisions about where to put their money. So, with that understanding, you might be wondering, how do these interest rates connect to the stock market? Stay tuned. Now that we understand interest rates, let's delve into how they impact the stock market. Imagine interest rates as the heartbeat of the economy, pulsating through every aspect of financial life, including the stock market. Lower interest rates often stimulate economic growth as they make borrowing cheaper. This encourages both individuals and businesses to take out loans and invest that money, either in starting a business, expanding operations, or even just buying a home. These investments can stimulate the economy, leading to increased corporate profits, and by extension, potentially boosting stock prices. Investors, seeing the potential for higher returns, may be more willing to invest in the stock market, further driving up prices. In a sense, low interest rates could be seen as a sort of adrenaline shot to the heart of the economy, quickening the pulse and stirring activity. On the flip side, higher interest rates can slow down this economic heartbeat. As borrowing becomes more expensive, businesses might hold back on expansion plans, and individuals might think twice before taking out a mortgage or car loan. This decrease in spending and investment can lead to lower corporate profits and consequently could cause stock prices to fall. In this case, high interest rates act like a sedative, slowing the pulse of the economy, reducing activity, and potentially leading to a cooler stock market. It's not necessarily a bad thing, though. Sometimes a slower pace can be just what's needed to keep the economy from overheating and spiraling into inflation. So, as you can see, there's a complex relationship between interest rates and the stock market. As interest rates rise and fall, they can have a significant impact on stock prices, influencing whether investors see the market as a promising land of opportunity or a risky gamble. It's a delicate balance, isn't it? But are all stocks affected the same way? Let's find out. You might ask, do all stocks react the same way to changes in interest rates? The answer is no. Delving deeper into this, let's consider a scenario. Picture interest rates climbing the ladder. In such a scenario, some sectors may find themselves in a favorable position. One such sector is the financial sector. Banks, for instance, often perform better when interest rates are high. This is because they can charge more for loans, which can lead to increased profits. Therefore, investors might see a more robust performance from their stocks in this sector when interest rates are on the rise. On the flip side, when the interest rates decide to take a downward turn, growth stocks often shine brighter. These are stocks from companies that are expected to grow at an above-average rate compared to other stocks in the market. Lower interest rates mean businesses can borrow money at a cheaper rate, fueling their expansion and growth. As a result, growth stocks tend to thrive in a low-interest rate environment. However, remember, this is a general observation and not a rule set in stone. Various factors can influence a stock's performance, and interest rates are just one piece of the puzzle. It's always crucial to conduct thorough research and consider all variables before making investment decisions. So, understanding interest rates can indeed give you a competitive edge in the stock market. We've covered a lot today, haven't we? We've dipped our toes into the world of interest rates and observed how they leave ripples across the stock market. We've also delved into the realm of diversified stocks, understanding which ones tend to shine brighter under varying interest rates. It's a vast ocean, isn't it? With each wave, there's something new to learn. Thank you for watching. If you found this video helpful, remember to like and subscribe for more financial insights. Until next time, keep learning and investing smartly.